So you're probably wondering, how can I make more money? I'm going to show you how people do it using insurance. So what is called is compound interest. Now, compound interest is simply your money making money on itself. So you're earning interest on top of your interest. Now, there's compound interest and then there's simple interest. Simple interest is simply you're just making money on your initial investment. It's not going to grow at the rate as compounding does. So for example, let's say that you invested $10,000 and your interest rate was 8%. So with simple interest, you're going to earn $800 year after year. So after year 1, you're going to earn $800. After year 10, you're going to earn $800. After year 25, you're going to earn $800. Now with compound interest, remember, it's interest working for itself. It's money just compounding on itself. So let's say if we took that same scenario, you invested $10,000, 8% interest rate. After year 1, you're going to earn $800. After year 2, you're going to earn $864. Year 3, $933. After year 4, you're going to be over $1,000. Why? Again, because the money's working for itself. You're going to then go to what we call the snowball effect. Now, how do people get to use this and make it work when they're, using insurance? So let's say that you have a death benefit. So when you die, this is the money your family's going to get. For hypothetical purposes, let's say it's $100,000. And let's say your premium every single month was $200. It could be more, it could be less. But for this, let's say it's $200. So every month, you're going to be paying $200 towards your premium, which will ensure that your family will have money once you die, whenever that is. Now, while you're paying this premium every single month, you're then going to be earning cash value. Now, with cash value, it takes a little bit of time for it to grow. Why? Because it's compound interest. So in the beginning, you may be getting a little bit of money every single year. It's going to start out small, but then it's going to grow. And then once it starts growing, again, you're going to hit that snowball effect, and it's going to start growing exponentially. Then you're going to have a lot of money going into it. A lot of money is going to start going into your compound interest. And this is how a lot of people make money. The issue with this is a lot of people don't have the patience for it. Albert Einstein said compounding interest is the 8th wonder of the world, because once it gets going, the amount of money you can make is crazy. Now, another thing that you're going to earn is dividends. So remember this $100,000 for your death benefit? That's not going to stay the same forever. That's actually going to begin to grow as well. So again, this is going to grow over time. Slow and steady. Year after year, it's going to grow, and it's going to do the same thing as your cash value. It's going to start growing. So by the time you die, that $100,000 won't be $100,000 anymore. It may be over $200,000, and it's not because you're paying more. It's because of the dividends, and you're going to take those dividends and you're going to reinvest those dividends as well, and your dividends are going to compound as well. So year after year, what a lot of people do is this is just like a way to diversify. So you may have like your 401k, or you may have a Roth IRA, or you may be investing in stocks or whatever. But this is another vehicle for investing. Now, there are multiple ways that you can actually, use compound interest. You can do it through your bank, which would be through like your savings account or a CD. But doing it through your bank is a horrible idea. Why? Because you won't even outpace inflation. It would take you forever to earn any money. And by forever, I mean to get like 1% back, it'd probably take you the rest of your life. If you notice, I continue to add money because the money is continuing to compound year after year. And you're paying your premium, but it's continuing to compound year after year. Another way, and the best way, is through the stock market. Why? Because the rate of return is greater. It's going to be greater than doing something like this, which is earning cash value and compound interest throughout life insurance. But again, it's diversification. So what you should do is you should be investing in the market so you can actually make money. But then also what you should do is you should have a life insurance policy that's going to pay you as well. Because when you take this money out after so many years, guess what? You don't have to pay taxes on this money. So it's kind of like a tax loophole. But it's going to continue to grow year after year. And guess what? We all need life insurance. Why? Because we're all going to die. And if you have a wife, if you have kids, if you have a home, if you have anything or anyone that you love or that's depending on you, you need life insurance. But guess what? I said life insurance. I didn't say death insurance. So look at all this money that you're making. Why? Because of compound interest. And look at this. Now your death benefit's going up. Yes, you're still paying your monthly premium, but that's a given. You have to ask yourself, like, what are you doing with your money every single month? And then you have to ask yourself, why can't you invest? Is it because you don't make enough? Or is it because you're frivolous with your money? So this is just food for thought. If you notice, like, we still have a lot of money left over. We still have a ton of money that you're going to get every single year simply from compound interest.